All right, everyone, welcome. In this lecture, we're going to break down one of the most fundamental principles in all of accounting, the critical difference between capital and revenue. You see, every business deals with two kinds of money, money that builds its future and money that just pays for today. Trust me, getting this distinction right, well, it's everything. So let's start with a simple question to get our heads in the game. Imagine a company builds a brand new factory. That's a huge cost. But then it also has to pay that factory's electricity bill every month. Both are expenses, right? Money's going out. But in the world of accounting, they're treated completely differently. So what's the deal? Why? That's exactly what we're going to unpack. Here's our game plan. First, we'll tackle the core distinction, what I call one cost, two fates. Then we'll see how this applies to money going out, which we call expenditures. After that, we'll flip it and look at money coming in, or receipts. And finally, we'll zoom out and see why this seemingly simple separation is so incredibly important for understanding a company's true financial health. Okay, let's dive right in. The fundamental principle. Every single time a business spends or receives money, that transaction has a destiny, a final destination in the financial statements. And it's the nature of that transaction that decides where it ends up. And really, it all boils down to one simple question. How long will the benefit from this transaction last? If it's a long-term benefit, something that will help the business for years to come, we call it a capital item. But if the benefit is used up pretty quickly, within this current year, that's a revenue item. Think of it like this. Buying a house is a capital transaction. Buying your weekly groceries is a revenue transaction. One lasts, the other is gone in a week. And here's where the rubber meets the road. This decision has a huge consequence. Those short-term revenue items, they go straight to the profit and loss account. That's the report that tells you how the business performed this year. But the long-term capital items, they go to the balance sheet, which gives you a snapshot of the company's financial position. It's a critical fork in the road for every single transaction. Okay, let's make this real. We're going to look at money leaving the business, what we call expenditures. This is where the difference between building long-term value and just, paying the bills becomes crystal clear. A really simple way to think about it is this. Capital expenditure is an investment. You're spending money to increase your ability to earn more in the future, like buying a new, faster machine. Revenue expenditure, on the other hand, is for maintenance. It's paying salaries or fixing things that break just to keep the business running as is. One is about building a bigger engine. The other is just about keeping that engine oiled and running smoothly. But hey, in the real world, things aren't always so black and white, right? Sometimes the line gets a little blurry. So accountants use a kind of checklist, a 5-point test, to help make the call. We ask questions like, what's the nature of the business? For a furniture dealer, buying a chair is a routine revenue expense. For our office, it's a capital asset. We ask, is this a recurring cost? Does it actually improve our capacity to earn money or just maintain it? This framework is the practical toolkit you use to get it right. Okay, time for a little pop quiz. Let's run through a scenario. A company pays some pretty hefty legal fees to finalize the purchase of a new office building. Where does that cost go? So what do you think? Put on your accountant hat for a second. Think about the purpose of that legal fee. Is it a recurring, everyday expense, or is it directly tied to getting a major long-term asset? Yep, you got it. It's a capital expenditure. That legal fee is a one-time cost that was absolutely necessary to acquire the building, a long-term asset. So that cost gets capitalized, which is just a fancy way of saying it gets added to the value of the property on the balance sheet. All right, let's try another one. A factory spends some money to replace a worn-out belt on one of its machines. This machine is, say, 5 years old. So capital or revenue? This is a textbook revenue expense. And why is that? Well, because replacing that old belt doesn't make the machine better than it was when it was new. It doesn't increase its capacity or make it produce more widgets. It simply brings it back to its normal expected working condition. It's purely a maintenance cost, and its benefit is keeping production going right now in this period. Okay, so we've talked a lot about money going out. Now let's flip the coin and apply the exact same logic to money coming into the business, what we in accounting call receipts. The big question you always have to ask yourself is this: where did this cash come from? Was it from your normal, everyday business operations, like selling your products or services? If so, that's a revenue receipt. Or did it come from a big, unusual, one-off event, like selling an old piece of property or taking out a massive loan. That's a capital receipt. Now, this is a fantastic example because it shows how one transaction can have two parts. Check this out. The company sells an old machine for $92,000. Now, that entire $92,000 that hits the bank account is a capital receipt. It came from selling a fixed asset, not from normal operations. But here's the clever part. Only the $2,000 profit on that sale is considered a revenue item that actually affects the profit and loss account for the year. It's a subtle but super important distinction. Okay, so we're at the home stretch. Let's tie all of this together and look at the big picture. Why have we spent all this time carefully separating these items? Why does any of this even matter? Well, it matters because it's all about painting a true and fair picture of the business. This right here is the whole point. This is the ultimate payoff. By correctly sorting everything into these two streams, revenue and capital, we create two different but deeply connected views of the company. The profit and loss account tells you the story of the company's performance over the year. How profitable was it? How efficient? The balance sheet, on the other hand, tells you its financial position, what it owns and what it owes on one specific day. If you misclassify even one item, you distort both of these critical financial stories. All right, so let's just do a quick recap of the essentials. First, the core distinction is all about the time period of the benefit. Is it long-term or short-term? Second, when we're talking about spending money, we're either trying to enhance our business for the future or just maintain it for today. Third, when money comes in, it's either from our normal day-to-day operations or from other significant sources. And finally, getting this classification right is what builds an accurate P&L and balance sheet. So at the end of the day, this isn't just some dusty old accounting rule. It's actually a powerful lens. The next time you look at a company's financial statements, try to see the story behind the numbers. The profit and loss account is its daily grind, its hustle, its efficiency. But the balance sheet, that reveals its long-term strategy, its ambitions, its foundation. Understanding this one distinction is truly the first step to speaking the language of business.